You bet. Thanks, Brian. Welcome everybody. It's been an exciting week in the market this week. My name is Henry. I'm the director of client services here at Market Structure Edge. So, in addition to writing a desk note every Wednesday and sharing my take there, I'll also, if you write into Edge or send emails, we're also available via email. I've been around since the early days of Edge. Have used uh, a number of different approaches to Market Structure Edge, but and we can talk about all of those today. Using it for trading, also using it for balancing portfolios and making longer term portfolio decisions. With that, I want to just give a quick overview of how to use Market Structure Edge. I know we have a couple new people, so this is sort of a daily process I like to share. I'm a discretionary trader, but I have a lot of data inputs that I utilize to make decisions on a daily basis. And all of that is process driven. So we're going to get started here. Broad market sentiments. So, we're looking at supply and demand in the market. We're looking at broad market sentiment. So this is our measure right now, broad market sentiment of how much demand there is in the market. So what you can see here, we always say there's sort of there's an entry and exit line. These are not just up and down lines. These are based statistically off of our back testing. We have an entry green line where, statistically probable for rising prices, and then the red line, we get to the red line and we know that there's a statistical probability for declines or at least muted gains from that. So that's broad market sentiment. The other thing that we're looking at is short volume. So all of this is based off of the State Street S&P 500 ETF. So we look at the the inflows and the outflows from that, and we also look at short volume. So we call that supply. What we're looking at here on this bottom graph is supply. You can see, I can take this graph back further. I won't right now, but you can see it right now. 52%, 52.1% is historically very high. Even if you go back, a couple weeks ago, it was closer to 48% down here. And so what we're really looking for is we're taking into account on a broad market perspective is what's happening with the purchasing of equities and what's happening with the short volume. So is there a lot of short supply under, because by that we can understand that there's a perception of risk within the market. So we get up here to over 51%. We know that there's quite a bit of not just downside expectation, but just expectation of risk and uncertainty. So I always like to put the caveat on short volume. It doesn't mean that the market's going to go down. It just simply means that there's an expectation of risk, and how hedge funds and investors manage their portfolios by hedging that risk. And so we can kind of get a perspective on the short side of what investors and what traders are thinking. So that's sort of the first thing that I go through is looking at broad market sentiment, understanding, is sentiment rising, is sentiment falling, where are we bottoming? If we bottom around 5, or if we've, looking back just even to February, I remember we were riding this like we could hardly get higher than 5, and then sure enough, we sort of broke down a little bit more. So understanding and getting really familiar with broad market sentiment, pulling it back year over year and looking how use under different conditions of broad market sentiment and short volume. So that's the first thing that I'm going to look at every morning is where are we in the process. You'll also see our options expirations mid-month and end of the month expirations are those little green dots. Those are very helpful just to remember what's coming up and where the turning points in the market are. I think I mentioned on Wednesday the amount of market price change that's developed through derivatives, futures, options, and we saw some of that take place last Friday, and then the bounce on Monday. So that's the first step. The second step is these. This is our core. I'm going to get into low volatility a little bit later, but these are our two core sort of drivers: momentum and low volatility. So again, Market Structure Edge, it's all based off probabilities. It's all back tested, not just on price history, but actually buying and selling history. Those are two different things. So the first of all, we have momentum. I think it was last November that we're looking at the stocks that have a tendency to be more volatile. We call them momentum when they're going up. I don't know what we call them when they're going down. They're going down faster. But that's our momentum portfolio. Those are the things that have higher volatility. We have a threshold of liquidity within both of these portfolios. We want things that are going to be tradable. But what I'm really looking at within both of these is the number of companies that are in momentum and the number of components that are in low volatility. So you can see, just a few days ago, I think on Wednesday or Tuesday, we had 9 components in momentum, and now we only have 3. So when you wake up in the morning and you're checking, well, what's broad market sentiment? How many components are in momentum? You're going to need those momentum names to carry the market higher. Similarly, and what we'll talk about later is when low volatility, when these populate, when that portfolio grows, we can expect that there's going to be a shift to low volatility. A lot of the times you'll see maybe momentum and low volatility. There'll be a lot of components. That's more of a bull market where we're just pushing really high, and you can hold on to those longs a little longer. In an environment where momentum's falling, you have to really be picky about where your spots are. So those are first two, again, broad market sentiment and momentum. Those are the first two things that I'm looking at every morning. Third is big tech. So, we've said for years now, the market, there's such a consolidation of the market. And the reason for that is because big hedge funds and big ETFs, they need liquidity. And so the place that they find that liquidity is in large cap and mega cap stocks. They're not able to find that liquidity for balancing baskets in smaller cap stocks. So they have to find that liquidity in large market cap stocks, which means we then also have to sort of, the whole market sort of gets boiled down to whatever acronym we're using at the moment. But obviously the largest big tech and large cap, mega cap stocks that we have. So I'll sort these by market cap. I've been saying for a while that Apple's not doing well. Even though it was rising, it's had 51%. What's interesting and what I want to point out is this demand trend. You'll notice in demand, all of these stocks have down. Tesla's topped. What's wild is these are relatively low short volumes. Google, relatively show. Meta, that's not a terrible short supply. Similar, Shopify matters less because it's not as big. But what I'm looking for is, how are these big companies? Are they moving together? When they're moving down like this, they're going to pull the whole market down with it, and it's going to be difficult to find things to go long on because the amount of stocks that are tied in baskets to these big names really matters a lot. So that's big tech. We talk a lot, and I'll just very briefly touch on it. Not just on volatility, so you can sort by volatility, but also by behavior. The major behavior is fast trading. I think Brian mentioned it. I mentioned it this week. Just the preponderance of fast trading. Market makers who are not interested in owning stocks at the end of the day. They simply are interested in arbitrage and keeping the market liquid and pushing it to a price point at which they know they can continue to make the market. So those are all really good things to know. Those are the three that's the overview. Broad market sentiment, how many components are in our default momentum and low volatility portfolios. And third, I'm going to take a really close look at big tech and what's going on within big tech. After I've sort of digested those three components, only then will I go to daily trading ideas. If you'll notice in my last two desk notes, I haven't even mentioned, there's really no need to mention any of these momentum names. I just am not going to touch them under these conditions. So if you're seeing broad market and big tech and the momentum portfolio decline, you're not going to see me mentioning momentum names. Just I've already sort of sorted them out of my brain, despite the fact that we have sorted by probabilities, that these are the two names that are going to increase. What I will do though is I will start to look at low volatility. So if we shift over here at low volatility, we can sort by market cap or we can sort by probability. I tend to sort by probability, first highest to lowest, and then that gives me an idea of what are these names. So I'll talk about it more, but the short story is when we recognize that there's a risk off environment, you don't have to go on a multiplied short position or even a VIX like a volatility position. You can also go on a risk off name. Like I mentioned utilities yesterday. They've had a great day today. Beverages and some parts of healthcare have had a great day today. So understanding that there's again portfolios, ETFs that have to be, I mentioned this in my desk note, that have to be allocated to equities, US equities specifically. So knowing that if there's going to be a risk off, when we see all of this money flowing out of big tech, out of momentum, out of these larger, very liquid names, that money is going to go and pinch itself into things like utilities and insurance carriers and that stuff that's very, relatively safe. So that's the daily process. I would encourage, Brian and I talked to somebody yesterday, 2 days ago, and I would really encourage you just to get really comfortable with these portfolios, with the process of Edge. It's different than just looking at price action. And I told a user on Tuesday, it takes at least 90 days, I think, to get really comfortable with Edge. And the more you use it, the better it gets. So that's as much as I'm going to share for now. I probably talked way too fast. But I'm gonna pull the reins there. We're gonna stop. I know last week we had a lot of questions around specific tickers. If you want to look at specific tickers, all of that's going to be in the context of broad market sentiment and momentum. But we can look at some tickers. We can talk about later what comes next. But I'll throw it back to Brian, and he'll get us going again.
Sure. Thanks, Henry. Real quick before I jump into a few topics, quick question for you. When you get let's call it a shock to the market, like yesterday's Liberation Day announcement and the declines that we're seeing today, what does that do for you as a trader? How do you treat things? What are you looking for? What's the next steps for you? Are you looking for stabilization before you jump back in? Talk me through your thought process a little bit.
I'm looking for a very friendly bar that's going the other way from the sell. So like if you were trying to grab another short position, I almost put this in my desk note, trying to grab another short position this morning is really, really difficult and very risky, because when you've sold off 3.5%, the likelihood is we bounce the other way 1%. And so the other difficulty, this happened at the election, and then it happened again yesterday, where all of this was post-market. And so there's easily, the volatility is a great opportunity, but trying to carry equity names after market overnight when there's this high of volatility, unless you have an excellent entry and a really confident entry, it's really hard to chase these things outside of market hours. And unfortunately, that's like the limitation, right, of not trading a more after, an instrument that's more liquid after hours. But if I'm not in the position already, or if I haven't already gone green, I'm not trying to jump in and catch the move, just because I'm still expecting, the volatility to remain. I tend to be a little bit of a, I'm looking for the bounce. If I miss the move, I'm looking for the bounce. If it's pushing higher like yesterday, I'm going, oh, this is a good spot for a sell-off. But after that, you kind of have to take a deep breath and pick your spots. But it's not easy, especially when it's not based necessarily in data. It's based off of, everybody's hedged right now, because it's unexpected and it's new territory. So just staying level at this point, I think, is very helpful. But there's also a lot of opportunity. So that was not a great answer. But I am, I'm looking for something to maintain before I jump in. I don't want to, it's too many falling knives, and I'm not looking to stay more than a day at this point. Like, I'm not holding overnight with volatility like this.
Yep. No, it's good. It's good. With my part of the presentation, couple thoughts. Brad, maybe we can get to your question before I get started. Yeah, great question, Brad. What we're looking at is it's the M, and it'll lead into what I'm just about to say. So I'll go ahead and share my screen, go over to what I was going to discuss, and that'll get into the sentiment, which you can think of as demand. So we'll get to that question, Brad. Right. Hopefully I don't have 52 screens open. Thankfully I didn't. What I wanted to start with, and for those who are longtime Edge users, you will recognize this. I won't spend a lot of time on it, but it's important to consider what's happening in the market just from a picture perspective. So this was the world to the left that honestly most boards, most CEOs, most CFOs are familiar with. It's basically what CNBC still espouses every day, that everything is about active investment. The reality, it's like waking up on a different planet. And what you're looking at is, think of it as a percentage of daily trading. So active investment is about 10% of daily trading, fast trading about 46%, passive investment 25%, risk management about 19%. And Brad, what we do in terms of the data for each individual company, think of it as like a weighted index. So we're assigning each company based on week over week trading, a weighted index in terms of the impact that has had recently. Let's say active money has been increasing. They're having a greater impact on the story. Well, that's going to get a weighting, but of course it's going to be less than the fast trading weighting, less than passive investment, et cetera. So one way to think about that, it's just a weighted index over time, but it's measuring actual demand. And it's an algorithm. When we back test the sentiment data over time and the pricing accuracy, for most companies we're looking at, it's about 95%. So when we talk to public companies, and I work for two companies. I work for Modern IR. You see that right here on the bottom. I'm a director of client services there, and then of course Edge as well. But when I talk to public companies, they're interested in the active investment story. That's what all of us are very familiar with. But there's more going on in the market. So just circling back to your question, think of it as a weighted index measuring the impact of all four behaviors on a week over week basis. And that's where that sentiment score is going to come from. Just for a second, wanted to also go to one additional screen here. Each one of these behaviors has a different reason why they're buying or selling in the marketplace. And this ties into why sometimes things need to get done. So active money cares about the stock story. They care about what's going on from a story perspective. Passive money cares about characteristics. So they're holding something based on the characteristics that particular stock possesses. It might be market cap, it might be volatility, it might be sector, whatever that may be. The machines are trading, and we're going to get into this here in a second with today's volatility. Price differences, they're trying to profit from the trading process or from short-term price moves. Those firms that fall in the fast trading bucket, they're looking to get flat by the end of the day. And lastly, this risk management component is that's where you think of derivatives, whether that be options or forwards or futures or swaps, whatever that might be. And that especially comes into play when we get into the expirations time frame. Now let's go back to the fast trading part of the equation here for a second. Obviously, we got a little bit of a surprise yesterday. If we look at what the market had been doing coming into yesterday, we had 3 days where the market had actually posted gains. So we'd been getting a little bit of stability. Short volumes had been coming down just a little bit. From some of the different notes that I was reading, there was kind of a hope out there that some of the uncertainty would come to an end. Well, that was obviously, not the case here. That brings up that fast trading component that I mentioned earlier. I want to take you over for a second to an email that was circulated internally today. This was sent out to our Modern IR clients, and we have about 80 different clients representing small cap all the way up to large cap, and we're working with investor relations teams. We're working with C-suite executives, that type of clientele. This email came from our vice president of client services. And the reason that I'm sharing this with you is I think it gives a good take on volatility in the marketplace. And I've highlighted a couple of things here. So essentially what happens is news comes out and news itself will be assigned a sentiment score. So this first part that I highlighted, when we first started to get some of the tariff related news coming out of February, options expirations, they were assigned negative sentiment scores. The market then responded. It started moving lower. Here's something fascinating though. There's another metric that those news analytics will look at. They will look at novelty tracking. So when that tariff chatter is out there for a period of time, it will start to lose its novelty, right? There's only so many days you can hear the same word being expressed. After a while, that novelty tracking will start to go down, and you'll start to see volatility starting to go down as well. Obviously, yesterday with Liberation Day, novelty has returned to the market in a big way. And we're getting that volatility that is returning to the market as well. We'll talk for here in just a moment about the volatility and maybe what to expect next. It's difficult when we get these huge bursts in volatility. But the last part of what I highlighted in this note is when we started to get that volatility in late February and during the early part of March, I showed you those 4 behaviors. We really never had active investors participating to the downside. We had a lot of fast trading activity, and we never really had some of the quants that were aggressively deleveraging either. Now, this is just the first start of this process. Will they deleverage going forward? I don't know. It's kind of day one. We'll have to see, how that plays out. But I just wanted to share that with you. Thought, and Brian is my direct supervisor on the Modern IR side. But I thought that was really good, just thinking about negative sentiment scores, how the machines react, novelty tracking, what that does in the marketplace. And then, of course, as time goes on, that novelty will go down a little bit, and you'll start to see that volatility start to dissipate some. Let's go over for a moment to take a look at what happens when we get volatility spikes. And this is the UVXY. There's a couple of them out there that are similar to this. This is the one that I'm the most familiar with, so it's the one that I just watch. What I wanted to share with you is a couple of different volatility spikes, and each one is a little bit different. But this is the one back in December. And you can see volatility just spiking over about a 2-day time frame. and then just really disappearing immediately. Now, March was a different story. When I was looking at this and thinking about it before the call, it was almost like an earthquake, and then you had like little aftershocks afterwards. So volatility would move higher, it would move lower, then it would move higher, and once again, it was almost like an aftershock after an earthquake itself. Obviously, this is today's spike in volatility, and let's see where it's at right now. That's 29%. So obviously a huge event that we're talking about today. I do want to take you back to March for a moment to show you what was happening to UVXY. And I've got a lot of data here. I apologize for that, but just concentrate on this last part here. This was the initial volatility spike in early March. And then it continued to move a little higher. It moved back. It moved higher again, it moved back, it moved higher again. So, and that was what we were looking at here with kind of that aftershocks, where it just continued to move higher for a period of time. I don't know how this one's going to play out. Do we immediately see it move lower again, or does it become more of a stair step pattern for a period of time? I'm inclined to think it's more like March. I don't have any proof for that, to be honest, because each one of these events is just a little bit different. The point is that volatility is difficult, right? If you look at what's happening in the market today, everything gets kind of thrown out the window. And what do I mean by that statement? Look at Apple today. Apple's down 9%. What's the normal volatility for Apple? 2.5, somewhere in there. Nvidia down 6, Amazon down 8, Meta down 7.5. So these volatility events get everything thrown out the window. When you're looking at the normal edge data over time, it can be very predictive. You look at the daily trading ideas and you get moves and low volatility. You know exactly what's happening there in terms of that volatility. At least for a little while, we're going to need things to settle down a little bit if you're trying to trade on an intraday basis. If you're looking at these names at the end of the day, you might have some decent opportunities. Let's say, for instance, they had low volatility today, maybe KVUE or ICE or what have you. You might have some opportunities. I might look at those at the end of the day, but just know from a general sense, when there's big news, the shock that we got to the system, and you can see it very readily here, it just tosses all that intraday volatility out the window for a period of time. I'll stop there for a second, see if there's any questions. I'll stop sharing my screen. Henry, anything coming in?
No, when I see that volatility, I mean, the reversion back down to 20 eventually happens. That's to me, given time, you have to give it some time, and you have to have the gut to let it go up to 40. But eventually volatility will go back below 28 and 27. So that's my own, when I see that volatility, and I don't trade volatility very often. But I think it's an excellent point. It's just looking at where those spikes occur and how to sort of capitalize on them. I feel like that's been something you've done really well over the last 6 months. So it's a good point.
Yeah, I had I had a 4-to-1 ratio on going into President Trump's address last night to the downside. I thought we would have volatility, and I just slightly hedged it the other way. The reason that I went that direction, and I could have been wrong, but I'll go ahead and share my screen again, is I was looking at the overall setup, and Henry had mentioned this in the note this morning, that when you look at sentiment that is sliding, so sentiment that is topped and is moving lower, and yes, short volumes were declining a little bit, but we're talking still historic highs in terms of those short volume levels. And I'll go ahead and get into a little bit of a discussion about, what is possibly next. Here's those short volume levels on a 6-month basis. You can see they're very, very high. We look at it on a 1-year basis. Still very, very high. And we actually had short volume on and this, what we're looking at, this metric with short volume, that's a 5-day average on a day over day basis. Yesterday, before we had the announcement, short volume actually increased by about 30 basis points. So that wasn't reflected yet in the 5-day average. What I'm going to be curious about today, what happens to those short volume levels? Do they continue to increase now? If so, with declining sentiment and with short volumes that remain historically high, it's going to be difficult to post gains here for a little while. You think about where we are from a sentiment perspective, and we're just now moving below the red line. So we're at 5.9. There is potentially a lot of room to move lower to even get to oversold conditions. Now, maybe that happens rather rapidly. I don't know, but you can see the potential maybe for some damage here for a little while. Henry had mentioned today in terms of the short portfolio. And Barry, I have 2 different short portfolios. I have what I call my Barry short portfolio and regular short. And I'll go ahead and share those with you here for just a second if you're interested. And if you want me to send over the parameters, I will. What Barry's portfolio is looking for, it's looking for those high flyers that are just starting to come back down a little bit. So in other words, they were high flyers, they made their way up to 10 or what have you. Now that sentiment is starting to decline and the short volume trend is starting to move higher. So that's what that one is looking at. And just an absolute explosion. Let me see what that number was. I've been tracking this for the last few days. Let's see. Wrong spreadsheet. Sorry. We'll get the right one here. Let's see. Went up to 59. I can't find the spreadsheet for some reason right now. But just an absolute explosion in those total number of names for Barry's short on a day over day basis. And in terms of the other one that I track, so think of this one as the high flyers that are just starting to move lower. And the other one that I track is sentiment that is starting to just really deteriorate. But it's sentiment that is moving below 4. So they're very different short portfolios. They serve different purposes. With sentiment that has been moving higher, it's going to be captured more in Barry's. There's not that much that's below 4 right now. But this one's increasing as well. So for those who like to short individual names or look at those, hit me up if you didn't catch these parameters, but we are in an environment. I think it's probably going to be choppy here for a little while, but there's potential for further declines with sentiment that's just starting to slip right now from 5.9, and once again short volumes that are high from a historic perspective.
That's great. Yeah,
and you can see, yeah.
Oh, I was gonna pull up, unless you want to go ahead on this, but I was gonna pull up the 2022 market.
Yeah, let me share one other item here.
Yeah.
I mentioned kind of choppy, potentially moving lower, and this, you can see it here very clearly. Early March, look at the weakness, you're going to move higher. Look at the weakness, you're going to move higher. That's the type of trading environment, that I expect here for a little while. And once again, I don't know how this volatility plays out. This is a huge volatility event. It's a shock to the system. I don't think it's going to be like this scenario back in December. Maybe it could be. I think it plays out more a little bit like this one, where we get those aftershocks for a period of time. And with that being said, I'll stop sharing and please go ahead and take a peek at 2022.
Yeah, so just a couple more minutes. I think I mentioned it this morning. Is I'm looking. What I'm looking at now is, you know, having the market down over 10% from highs. I'm saying, when's a good time to reallocate? When's the good time to add to my long term portfolio? Like I said, this is a great opportunity. I think myself and along with others are probably wondering, so when can we reallocate? And so I wanted to hop over to, I keep looking at 2022. Obviously we had rate changes that year.
And can you share your screen, Henry? Yeah, thanks.
Yeah. It's just a similar environment. And what I'm finding here is, all of these troughs and peaks are very tradable. But for re-entry and reallocation, what I'm looking for is an alignment of both low short volume and a bottom sentiment. So if you look at what I think is the best one is right here, where we really had to get down, broad market sentiment, it twice it went this low. 1.9, you see 6, 7, so this was June. Obviously we declined all the way down to right below 2. What we also saw right at that similar point was that we also had falling short volume. So that, to me, once we see a really solid bottom, that's an opportunity for entry. Again, we see it here. It doesn't happen when it does, the entry point doesn't happen up here. We have to wait until we get down into this trough, until we really sell off, until even short volumes bottom. And then that becomes an entry opportunity for the long side. My caveat to all of this is that I think it may take some intervention at some point from an interest rate perspective. I think that's what people are hoping for, but that doesn't really, we don't have to depend on that as traders. I think from a longer term perspective, what I'm really looking for is allowing the sentiment, this broad market sentiment score, to really get down to hit in this trough, and to also see this short volume flatten out here in order to get long, so we can get some of these more sustained long-term, these long-term trades versus just day trading volatility. For now, I don't think we're there, but we still have a couple weeks till expirations, and so there's a chance that we just hang out here. But we'll see. I'm not confident one way or another. We've had the big move already, so what comes next, I'm a little less sure on a daily basis, but on a longer term allocation, I want to see a bottoming short volume and a bottoming broad market sentiment. Both of those things together. If I can get big tech in alignment with all of that, where it's like, man, big tech's really sold off, it's all in the gutter. When everything's in the gutter, that's when I'm gonna, and then I finally see that little bit of uptick or that flattening in sentiment at a bottom. That's when I'm gonna go full force long. But not until then. And we've just turned the corner and we've already had significant selling. So I have to wait for that next.
Yeah, no, that's good. That's a really good point. I'll share one additional point and see if you guys have any questions. Oh, by the way, I found the number of names as we were going here. So this is my very short portfolio. You can see everything. There was like nothing going on about a week ago. There was only 7 names in there. Look at the increase over time here over the last few days, all the way up to 59. I've only tracked this for about 3 months, but that's a huge number. And you can see the other short portfolio, really increasing over time as well. What I wanted to share with you, as we potentially look ahead, we already talked about this, you get those brief moves higher for a period of time. When did the market rally this was about a 4% move higher. When did we get that rally? About a week ahead of expirations. And you think about what's going on in the market is you get a lot of those derivatives instruments that just get washed out. You don't have many days left in terms of time decay going into expirations, and you get some real opportunities potentially, for hedge funds to take a chance, on a short-term rally. And you can see what happened as well is, shorts had been really covered. So as we started to get demand heating up a little bit, well, there was limited supply getting in the way, and boom, you had 4% advances. So it's just something to think about. Like Henry said, we could be in a bit of a mess here for a little while. Nothing is ever linear when you get these huge volatility events. It tends to be very choppy, the move going forward. How am I going to trade it? I'm going to look for opportunities to get back into UVXY. I'm taking my profits in that name today. I think we'll probably have what I mentioned earlier is I think we probably have this type of trading. I don't have any science backing this up. These volatility events are each a little bit different in terms of how they play out. But personally, that's what I'm going to be looking for. Anything that we can address here before we take off today? Barry, were we clear as mud today?
Yes, absolutely. I think this is when you pull out my portfolio, definitely I started seeing the red flags, even though the market was going up.
Yep.
My short portfolio was telling me underlying there were issues, and that allowed me to be cautious. And I think today's a good day to use Market Edge. If you trade the same stocks over and over, this is a great opportunity to see how they respond to supply, demand, and volatility, to really get a feel for how they act in these hard times. You take a stock like BBAI, which was a darling. They've done a great job on their balance sheet. I'm not promoting them, but when you look at them, they've barely moved.
Mm-hmm.
I mean, it's barely moved. And there are stocks like that have not responded to the mayhem that we're seeing across the board. And it's not one that Market Edge or MSCs follows, but by the same token, it's just an example of how I use it to kind of see how stocks are responding today and tomorrow.
Yep. And, when you look at the, sectors that are doing well today, Henry had mentioned it earlier, it's your utilities, it's your consumer staples, it's your gold stocks, it's the defensive stocks that if you need to be 100% invested, what are you going to be invested in? Or you get some of those arbitrage plays where perhaps there's a deal going on and it's, 2 months until the deal commences, and, people kind of plow into some of those as well. But once again, it's very defensive in nature. And you're muted, Barry.
Oh, when you look at the population and the low volatility recommendations, rather interesting how big that was compared to the others, right? And so for between today and tomorrow, I'll be looking at that and going and saying, okay, which stocks between those 2 days are actually doing okay? And that's kind of a place to go play when there's so much uncertainty.
Yep, absolutely. And I think with that, unless there's any other questions, Henry, any last words?
No, that's it. Thanks so much.
Thanks for the wise words, Barry. Barry actually mentioned a great point last week because it was a very difficult environment before volatility hit. And he mentioned, hey, great environment to sell premiums. And I thought that was a wise word of advice last week. But with that, I think we'll end it today. I'll go ahead and turn off the recording. Thank you very much, everyone, for joining us. It's always a pleasure. Have a great rest.
Thanks, Barry. Thanks, Brian. We'll see you.
Mm-hmm.
See you guys.
See you later, Barry.